I was a little nervous about coming here. Sweden. Can you believe what happened last night in Sweden? Oh my God. What have I got myself into, I'm thinking. So people said, go to the Fotografiska Museum, which I did on Saturday. And I was somewhat relieved that last night in Sweden wasn't as bad as it could have been. So still a little bit nervous about being here after dark, but it's a pleasure to be here. I'm a fan of Telia for reasons other than their company color being purple, which, as you can tell, I'm a big fan of purple. In fact, I'm thinking about going all purple, at least with shirts and ties. So this is my third day in a row with a purple shirt and a purple tie, and each shirt's been different and each tie's been different. So I think I'm on a roll. What I'm going to do is scream through a lot of information pretty quickly, so we have time for the panel and for questions. There's 51 slides in this deck. Some will go by so fast you won't even see them. I'm happy to make the deck available. I should warn you up front that the material will be somewhat on the boring and arcane side. As you can tell from the title of my talk, ESG integration, role of boards, trustees. We're going to talk about fiduciary duty a little bit. We're going to talk about materiality. Good news is that this talk is not as boring as the one that I gave at the Stockholm School of Economics this morning, which was on whether the International Accounting Standards Board and the Financial Accounting Standards Board in the US should take responsibility for setting standards for non-financial information, a spellbinding issue, as you can imagine. So we had about 60 people take a nice nap this morning at the Stockholm School of Economics while I went through that. So let me frame this a little bit in terms of the SDGs that Anne talked about at the beginning. What's interesting is that you're starting to see companies anchor their strategies to a certain extent on the SDGs, and you're seeing investors talking about how the SDGs create opportunities. And the narrative that's emerging is that we need around $6 to $7 trillion a year to accomplish the SDGs by 2030, and at least 2/3 of that's going to have to come from the private sector. So it's going to be decisions that are made by companies, that are made by investors. That's where the capital is going to come from. And so what determines how those capitals flow? How many people here are from companies, just to give me a sense? And how many people are from investors? So what I find is that there's this finger-pointing exercise that's been going on for a while now between companies and investors, where companies say, gee, we're doing all this great stuff in terms of sustainability, and the investors don't give us credit for it. All they care about is our quarterly earnings. And the investors say, we think the sustainability stuff is important, and I'm going to give you some data that it's increasingly important, but the companies don't do a very good job of explaining to us what they're doing. We don't get data. We have the quarterly calls, we have the investor presentations, and so really what this talk is about is how to close this communication gap between companies and investors, what Johan was talking about in his video here around kind of a sustainable strategy. We don't have the language for talking about that between the companies and investors. And to kind of cut to the chase, one of the big constraints on this is the lack of high quality data. So I'm going to talk about data, I'm going to talk about materiality, and I'm going to talk about fiduciary duty of boards. And so this is where it gets to be pretty fast. So this is a study that I did with State Street of 582 institutional investors. It was a global survey, a third the Americas, a third Europe and Middle East, third Asia Pacific, half asset owners, half asset managers, half equity, half fixed income. And the focus of the survey was ESG integration. And the results that I'm going to show you, it's just a portion of them, I'm happy to make the paper available, are things that were really invariant across regions, across asset classes, and asset owners versus asset managers. Just real quick, we'll ignore the retail part of the survey. The choices of ESG investing strategies, most people, 47%, and these were not exclusive, you could pick multiple ones. The most common is still exclusionary screening, the traditional way people think about socially responsible investing, but you see coming up best in class, thematic investing, Full ESG integration, which is the focus of what I'm going to be talking about. Active ownership is engaging with companies, and then this growth and impact investing. That's its own complicated story because impact investing means different things to different people. It basically came out of the private sort of sector world where it was, kind of NGOs and philanthropy, and now it's being talked about by big asset managers like BlackRock. This is the distribution of assets, which is pretty typical. So, a couple of big players and, smaller players and so forth. Here's how long. So we went to specifically investors that had been doing ESG investing. So we had a targeted sample, so it's not representative of the universe. We were looking for those investors that were on the leading edge, and we said, how long you've been doing it. Again, we can ignore the retail data. 29% for the past year, 2 to 5 years, 33, only 14%. So it's a relatively new phenomenon. Some type of ESG investing, whether it's screening, thematic investing, ESG integration. So we're in the early stages of the journey. The reasons were interesting. The one I'd want to flag is this 62%, is it helps to foster a longer-term mindset, right? So it's like long-termism and ESG are two sides of the same coin, and I'll give you some data that demonstrates that. So you're not going to get, as the investors say, outperformance from ESG, from factoring in the material, environmental, social, and governance issues this quarter, this year, maybe even over the next 2 to 3 years. So this requires patience on the part of both companies and the part of investors to be able to see the benefits that come from integrating the material ESG information with financial information. I'm going to quickly talk about what the 3 commonly perceived barriers are, because they're not as big as people think based upon the survey, and then I'll focus on what the barrier is. The first one is that for the longest time, people said, gee, if we do this ESG stuff, it's going to hurt financial returns. This is doing good for society, it's good for the world, but it's a transfer payment, and so it's going to hurt returns to investors. There's data that says that's not true. It's a little complicated, the empirical stuff, but on a perceptual basis, about half don't think that's true anymore. Of institutional investors, about a third still do. 17% say they don't know, which is interesting. I think if we had survey data from 5 years ago, that 48% would have probably been more like 75%. So we're kind of getting past this belief that's not necessarily grounded in facts that ESG investing, incorporating sustainability issues is going to hurt financial performance. This is where it gets to be a little bit arcane. So this notion of the fiduciary duty of pension fund trustees, the question was, and the way it's been framed historically, is that the duty of the trustees is to maximize the return for the beneficiaries. So if you're part of a pension fund, you're a beneficiary of a pension fund, and what the trustees are responsible for is making sure that the investment process is going to deliver the returns that are expected and needed for you to fund your retirement over the long term. And for a long time, it was like, okay, what that means is we only can focus on financial information, financial results, and this ESG stuff is off the table. But fiduciary duty views are changing. So the question was, is the concept of fiduciary duty that you are discouraged or even actively precluded by law from having your fund take ESG issues into account, moving towards favoring it or even requiring it? You can see that there's a shift and a little bit of differences between asset owners and asset managers, but 40% basically agree that the direction is towards fiduciary duty supporting ESG integration, and about 22% saying that it's not moving in that direction. And you get about a similar thing between asset owners and asset managers. Part of what's driving that, PRI, Principles for Responsible Investment. They've got this big program they're doing, Fiduciary Duty in the 21st Century, producing these reports, basically arguing now that you're violating your fiduciary duty if you don't take these into account. Because remember, going back to long-termism, CalPERS, they have a 100-year tail liability. Look at who their members are, and they're coming along, and what the lifespans are. So this ESG stuff is going to matter over that period of time. Resource scarcity, water, climate change, social inequality. There are these systemic trends that create systemic risks for universal owners, and so you would be violating your fiduciary duty if you don't start taking these issues into account. Talked about sort of time frames. So when do you expect to get outperformance? 7% think you're going to get it in less than 3 years. 2/3 say, well, it's going to happen over the next 3 to 10 years. So that's the good news, right? The investment community is realistic when they're making these decisions from an ESG investing, ESG integration point of view, how long it's going to take before they're going to see what the benefits are in terms of financial performance. This is like an impossible slide to see. So just let me whine a little bit to the side. So I enjoy doing the study with State Street. Myrta's great. She's the head of the Center for Applied Research. And when you do things with a big bank, compliance gets involved, and legal gets involved, and PR gets involved, and marketing gets involved. And the worst part is that creative gets involved. So we sat down with the creatives, right? And they're dressing even crazier than me. And they came up with this chart. I said, oh my God, nobody's going to be able to read this. You know, we can't have it. But the creatives won. So let me tell you what this says. This looks at the time frames for evaluating the performance, asset owners of their internal portfolio managers, asset owners of the asset managers, the third-party managers that they use, asset managers of their portfolio managers, and asset managers of third-party managers that they outsource some of the stuff to. The important part is that most of the tall bars are over here, 3 to 5 years. Very few 5 to 7. So remember, realistic about time frames, but in terms of the time frames in which performance is evaluated, they're shorter. The bottom one is the investment time horizon. So like how long is your investment time horizon, how you're thinking about it. And it's interesting that the asset owners, there's 37% that have got an investment time horizon of 10 years or more. But they're evaluating their asset managers under a shorter term time frame. So there's a mismatch between the time frames that investors have for when they expect to get the benefits of ESG integration, the time frames that they're using for evaluating performance, and the biggest problem is the time frames for performance evaluation for compensation decisions, where you have, I guess it's 70%, almost 3/4, are evaluated on an annual basis. So that's clearly something that's a structure that's going to have to change to facilitate ESG integration. So time frames need to be adjusted. Fiduciary duty is really not a problem. The perceptions are changing about ESG integration hurting returns. What's the biggest barrier? The biggest barrier is the lack of high quality data for environmental, social, and governance performance. This was my whole talk this morning. We've got good data on financial performance. We've got accounting standards. We've got reporting requirements. They've been around for a long time. They're enforced by the state. There's auditing firms that make sure they do it right. We don't have the same social infrastructure that's necessary. We don't have that kind of plumbing in the capital markets to provide the same quality of data on a company's environmental, social, and governance performance as we do financial. So 60% of the institutional investors cited the lack of standards as a problem. 53% weren't all that happy with the data that they were getting from companies. And cost associated was not a big deal. Lack of ESG data from other sources. That's kind of interesting. There's at least 2 main data vendors, Sustainalytics and MSCI. And if you ran a regression in terms of the extent to which their rankings and their ratings agree with each other, the R squared, as they like to say, is very low. It looks kind of like a cloud of dots. And it's like this big open secret. So MSCI says, you know, Telia is good on this, and Sustainalytics says they're not so good. So it's kind of a mess out there. And that makes it very hard, right, for investors to make these decisions. This we can skip. Let's talk about materiality. The other slide was more interesting, but like I said, I like the boring stuff. So let's talk about materiality. My first book was on transfer pricing. I met my wife on a blind date. All I talked about was my book on transfer pricing. She married me anyway. Lynn's met her. Lovely woman, go figure. I've gone from one boring thing to the next. So here's materiality. All these organizations have views of materiality. Materiality is the key concept to distinguish between sustainable strategies, what Johan was talking about, and sustainability strategies. The SEC's guidance is a piece of information is material if in the total mix of information it would influence a reasonable investor's decision. I mean, what kind of guidance is that? The International Integrated Reporting Council talks about materiality. GRI talks about materiality. The Sustainability Accounting Standards Board talks about materiality. Materiality is really at the guts of what investors care when it comes to ESG integration. How many people know about SASB, Sustainability Accounting Standards Board? You know, so many of you. Basically, what they've done is an NGO. What's material is going to be sector specific. Dealing with privacy issues is important for a communications company, access to medicine for a pharmaceutical company, systemic risk for a bank. So different issues that investors would care about. So they provide guidance on materiality for 79 different industries. So we asked in this survey of institutional investors, yes or no, would you like for the company, Telia, whoever, to identify what they think are the material issues and report on them? Provide the information. 92% said yes. It's crazy, right? You never get 92% in a survey. 92% want the company to identify and report on the material issues. The number of companies that are doing that to any degree of rigor, you could probably count on one or two hands, right? They go, we have our sustainability report and we're doing all these great things. And you look at their quarterly calls and you look at their investor presentations and there's nothing about sustainability. There's nothing. And there's certainly nothing about materiality. So then we said, okay, so you want to get this information, who should decide? And it was multiple choice, so it doesn't add up to 100%. Well, this is interesting. Almost 2/3 said the board of directors. And I'll come back to the board of directors at the end and talk about Telia. So 2/3 said we think the board of directors, they represent, they decide about the role of the corporation and society. So 64% board of directors, chief sustainability officer, 39%. Third, want to outsource it to some standard setter, 25% to a data provider, about 1/3 to the CEO. Not a big difference, but kind of probably better from the CSO than from the CEO. Although, no offense, most CEOs kind of don't talk in capital markets terms. The most telling statistic is that 14% want it to come from the CFO or the head of investor relations. 14%. It's like nothing. So what the market is saying is that, okay, we are interested in ESG integration. We'd like to get better data. We want to have the material issues identified. We want the company to explain to us how it's related to financial performance. We're probably not going to get that from the CFO or head of investor relations. They know how to talk about financial stuff. And the sustainability people know how to talk about the sustainability stuff. And the only way we're going to move these trillions and trillions of dollars of private capital to support the SDGs is to close this language gap and to come up with some common sets of terms as to how we talk about it. Probably should quit talking about sustainability so much, talk more about materiality, even though it doesn't sound as cool, because that's where the rubber meets the road. And as I said, you can count on one hand the number of companies. One of the most interesting examples, and it's not really embedded in their presentations the way it could be, go to SAP's integrated reporting website. It's a nice website. Find a page called Connectivity. And you'll see that there's this little circle that's got 13 little bubbles within it. I think 3 or 4 economic variables, and 4 or 5 are economic, and 5 or 6 are social. And you click on each one, and it shows you this financial thing affects this environmental thing. or this social thing, or this environmental thing affects this financial thing. And they're even to the point now where they're saying they're giving numbers on, an X% reduction in carbon emissions contributes whatever the number was, I can't remember exactly, 60 million euros to the bottom line. Or a 2% increase in the employee health index contributes 50 million euros. So we need to get to that point. Companies need to be identifying the material issues, articulating the models. The previous slide said 2/3 think it's possible to do that. So you've got an integrated communication. Here's the material sustainability issues, sector specific. Here's how they affect revenues. Here's how they affect costs. Here's how they affect assets, liabilities, our view on cost of capital. To do that, we need better data. Here's why materiality is important. There's this good friend of mine, George Serafim, who did this lovely study. And I'll spare you kind of the research design. What does this show? They took the SASB sectors, looked at what the material issues were for that sector, created portfolios of companies that were performing well. It wasn't a transparency thing, it was a performance thing. Companies performing well on the material issues for that sector, access to medicine for a pharmaceutical company, privacy for a telecommunications company, and so forth. Their financial performance was much greater than companies that were performing poorly on so-called sustainability issues. Now, as I said at the beginning, there's a time frame issue here. It was about 8 or 10 years before it kicks in. So the materiality of sustainability from a financial performance point of view, did it for stock prices, did it for accounting returns, was demonstrated. Companies performing well on the immaterial issues, so things that are perfectly good things to do for the world, but aren't really important from an investor point of view, their financial performance is actually a little bit less. So if you're doing well on things that really aren't critical for your sector, your financial performance would be a little bit less. It wasn't all that statistically significant. The most interesting finding was that the highest performance came from companies that were performing well on the material issues and were performing poorly. Their performance was actually bad on the immaterial issues. And what that means is that there was, by some process, resource allocation decisions that were made. These are the things we're going to put time in, money in, management attention, capital investments. These things we aren't. And when they made those decisions, the financial performance benefited, again, over a period of time. So what this shows is that if companies were to do a better job of identifying and reporting on the material issues and making the argument, the explicit argument for why this is good for financial performance, it will be good for them. It will be good for investors, because investors will then have at least the company's point of view on what it is that they're focusing on, as opposed to saying, we care about sustainability and we're a good company and somehow that's going to contribute to financial performance. It can, if you're focusing on the right sustainability things. Let's be honest, it might hurt if you're focusing on things that are immaterial. This is something that I'm going to go through really fast, so you can just get the report. So I did this project with BCG on something called Total Societal Impact, and we did a lot of cool things. So George's study looked at portfolios for sectors. So this project I did with BCG, we took it down to a more granular level. And we looked at 4 industries: banking, biopharmaceuticals, consumer goods, and oil and gas. We took SASB as a starting point for what's material. We got data from MSCI and Oicom to get the performance metrics. And what we were able to show, and you can get the report and we go through all the methodology, we were able to show 2 things. One was that there was a valuation premium that came from companies that were performing well on the material issues for their sector. And the valuation premium, we'll come back in a second, sort of varied. It was between the 90th percentile and the median of the 50th percentile, 11%, 12, 19, and 3%, and so forth. So we were able to show a valuation premium. When you ran a regression equation for basically predicting stock price or value. They've got this fancy model. The ESG data explained another 9% of the variance in an R-square. 74%, they can explain 74% with financial information. Capital markets aren't efficient, right? Because when you put in with these additional data, what this gave you was a better fit to the model. So it shows there are value enhancing things from having this information. And then we were able to take it down at a very granular level and show for particular issues, so socially responsible sourcing here for consumer, 4.8% in gross margin. So down to very specific ESG issues that were material for that sector to show what the impact was on margins. EBITDA, gross margins, and in the case of banking, it was net income because it's a different sort of business. So what you have is an increasing set of empirical evidence that this really does matter. It matters if you focus on the material things and you manage them well and you start to explain them. How do you do that? This is another part that's going to go really fast. This is where we get into why I like Telia. Integrated reporting. Probably you've all heard about integrated reporting, right? So it's you take what's the material non-financial issues and you put them into an integrated report. You're not just kind of slamming together your sustainability report and your financial report. Most integrated reports, to be honest, are just like this bolt-on exercise done by some PR firm afterwards that doesn't have anything to do with how the company is managed. Done right, you've gone through this exercise, you've got the discipline, you've identified the material issues, you've articulated the relationships to financial performance. It's a framework, guiding principles, content elements. This is another one of these graphs that I'm not responsible for, that it's impossible to see. All that's important here is that you've got the 6 capitals: financial, manufactured, natural, social and relationship, human, intellectual. Companies use those capitals and they have impacts. You're talking about the positive and negative impacts, the externalities. Financial accounting takes care of financial and manufactured capital. It doesn't touch the other capitals. What groups like SASB are trying to do is to deal with these other capitals so that companies can say, these are the resources we're using and these impacts we're having. Here's some organizations doing this stuff. GE published the first integrated report. I still think you should do this, but that's another conversation. Real quick on this. So chapter 5, and my last book on integrated reporting is Materiality. It's kind of a little wrap I just gave you. And then how you think about the sustainable value matrix, not a materiality matrix. So it's like, okay, bottom is stuff that's material to the company. Materiality is anything specific. They've got a view on what society thinks is significant. This is the stuff that is good for investors and therefore good for the company and good for the world. These are things that are important for investors that the world doesn't necessarily care about. These are things that other stakeholders care about that investors don't. That can change. That's sustainability reporting. And companies have an obligation to other stakeholders. They can't ignore them. These things nobody really cares about. They're not material. They're not societally significant. And again, you look at sustainability reports and there's very little guidance to help you separate which goes into each one of these buckets. And so people have to hunt and peck through to try and figure out the information that they want. So let me wrap this up pretty quick. There's a question of fiduciary duty on the company side. So we talked about fiduciary duties of pension funds, and they have to look out for the beneficiaries, and if they look at the ESG stuff, they're going to get in trouble and go to jail. Not true, that's changing. You've got the same issue for companies. So everybody thinks that the fiduciary duty of the board is to put shareholders' interests first. Right, an activist investor comes along and shakes it up, some hedge fund, and the board is supposed to cave and say, fine, 30% premium to the stock price, we're going to sell out. Actually, that's an urban myth. And I've got legal memos on fiduciary duty for all G20 countries and 15 others that say the duty of the board is to the corporation. Now, in Sweden, it says corporation and shareholders. Basically, it says corporation and shareholders in the United States. There's no country where it says the duty of the board is to shareholders. So the duty of the board is to think about the long-term interests of the corporation And then I would argue, this is what the statement of significant audiences and materiality is about, who are those other audiences, a subset of stakeholders that are significant, and addressing what their issues are, is going to ensure that a company can create value over the longer term. Mannheimer Swartling wrote the legal memo here. It's kind of cool if you like to read this stuff. Let me wrap it up with Telia. So as I said in the beginning, I like their taste in color. Purple stuff over here kind of matches my tie. It's a little bit muted, but we can get me a Telia tie. I like them for more substantive reasons. They've been doing integrated reporting. Atlas Copco is the first company in the world, Swedish company, Sweden, first Swedish company to publish a statement of significant audiences and materiality. Was it a year ago? Henrik first showed me. So like one day I'm sitting there, out of the blue, I get this email from Henrik. Where's Henrik? There you are back there. Thanks for the email. He says, hey, Bob, just wanted to give you some good news. We've published a statement of significant audiences and materiality. This is a really big deal. It's in their integrated report. It basically goes down to Swedish law. We talked to the general counsel, and actually usually the general counsel, the one that's nervous. Very interesting discussion. We wrote up a little piece on Telia, which is on Sloan Managed Review. As you think about it, yep, under Swedish law, we probably should be thinking about these audiences. They identify the different stakeholder groups. They talk about, these different guidelines and things they follow. There's 2 companies in the world that have published this. Anne mentioned the statement of significant audiences and materiality campaign. My goal is that by 2025, and I'm not kidding, every listed company in the world publish a statement of significant audiences and materiality. It's 1 page. It comes from the board. It's not a heavy lift. It's a question of will. It's values neutral. If you want to come out as the board and say, look, our only significant audience is short-term shareholders and this ESG stuff doesn't matter to us at all because we want to play the earnings game, you can do that. You can make that call as the board. Just be honest about it. If you feel differently, then kind of man up and be explicit and say, okay, these are the significant audiences. These are the time frames that we're thinking about. That then leads to the determinality, the materiality determination. Here's the metrics, here's the targets, here's how they're related to financial performance. So my concluding message, if you're from a company, it would make me really happy. Not that it's your job to make me really happy, but it would make me really happy to get an email from you like I got from Henrik that says, hey, Bob, good news. My company is also publishing a statement of significant audiences and materiality. You need to get the ball rolling. Sweden's a good place to get the ball rolling. I'm working with Hermes Equity Ownership Services, different countries, different sectors, get the ball rolling. If you're an investor, then my exhortation to you would be to, as you engage with companies, where's your board coming from? Who are the significant audiences? What are the time frames? Have you identified the material issues? What are they? What metrics are you using to measure your performance on these material issues, and how do you see those related to financial performance? And with that, let me stop, and we can do our panel, or whatever's next.
Thank you very much, Bob. That was extremely interesting. I'm very impressed by the speed. You had 51 slides. So. Okay, that's good to know. The good news is that you will all get these slides. So we will be emailing them tomorrow. So if you register through the website, we have your email address and you will receive.
Cool.
Thank you very much for that. Yeah, please have a seat. I wanted to say very quickly about the statement of materiality that we have in our annual report, and we were a little nervous. It was not only the general counsel that was really nervous, but we were sort of thinking that, so how is this going to go and how will it be perceived with our board? And it was actually a fairly easy process towards the end. It was a very useful discussion, but it was at the end it was more about formalizing what we do and really putting the board's signature under it. It didn't mean that we now all of a sudden need to start doing something completely different, but it said that this is the way this company is run. And it gives us a super tone from the top when we discuss sustainability issues. But thank you again for the presentation. So you will be now joined at stage by another doctor. So Dr. Lynn Leopold is maybe familiar to many of us in this room. Please come to the stage. And Lynn is the Executive Director of MISUM and Associate Professor at the Stockholm School of Economics. She has previously been the Associate Dean for SSC MBA programs and Visiting Fellow at the LSE, Center for the Studies of Human Rights, and Visiting Professor of INSEAD Strategy Department. Another very impressive resume there. She currently teaches strategic corporate social responsibility and sustainability management in graduate level degree programs, as well as working on research. And she's currently focused on contextualizing a model of corporate responsibility and human rights interpretation, linking institutional, social capital, and stakeholder theory. And important also is that before completing her PhD, Lynn worked 10 years in corporate strategy in the international oil industry. So you have very good view on what our work looks like as well. Welcome, Lynn. I would like to start with you, Lynn, and hear sort of your reflections on Bob's presentation.
Yeah. Thank you for that introduction. Can everyone hear me?
Yeah.
Yeah. And let me say that I have met Bob's wife, and I do understand that even with transfer pricing books that she got charmed by him. We all are at SSC as well. So what Bob went through today, of course, most of it I both recognize and, of course, have seen the same thing. We have a very large project on financial systems and financial market actors at the Mr. Center of Sustainable Markets where we work. I do agree, not least of all, that it is getting more and more important, and that also is reflected in your study and your data. I also agree, not least of all, the problems with the standards and comparability and comparison, because there are many, many standards, and I know that you discuss a lot SASB, and there's many more here in Europe. I think we've talked a lot more about GRI, and most of the Swedish companies are members there. But I do know that it's a huge issue that we don't, for investors, either institutional or retail, it's very, very difficult to be able to compare the different standards and the different companies with each other. And there's a lot of complexity in how the data is reported. And I think there's also a lot of competition between the standards here. And I think that's also one of the issues, not least of all. Long-termism, absolutely, and the fact that bonuses and incentives are really much more, even though one can talk about long-termism, especially among institutional owners, the incentives are still very much short-term of the actors there. I think, not least of all, we had, there was a big conference that TI organized last, I think it was in June this year, where we had a panel in MISUM with different institutional owners. And they're still very much on the kind of the bar on whether or not there's an economic, if actually ESG matters from an economical perspective, but do they really perform any better? They basically came out and said, well, at least they don't do worse than others. So there's a lot to do there in understanding of it. And I think that study that you had on, or Sedafim's study there was incredibly interesting from the SASB perspective, that they do actually perform on the materiality aspects. I think one of the most important things, not least of all, is maybe we should be stopping to talk about sustainability, but indeed on materiality. I think the biggest issue, and not least of all from a perspective of someone who's sat and actually gone through reports on the GRI reports on materiality, how badly they're done most of the time. It's easy to throw up this 2 by 2, but it is really, who is it that you're talking to? I mean, you can do this very corporate-centrically. You can actually, basically plot out what you'd like it to look like, and then you decide who you're going to ask, and then say that you've asked your stakeholders, in a sense. So there's a huge issue when it comes to that. There was something that you didn't talk about, which I would love to hear you talk more about, is that when we look at the SDGs, not least of all, the 2030 agenda, there's a lot of criticism to companies that there's a lot of cherry picking coming out here. And I can really see the possibility of, if we're talking about materiality from this perspective, how we could actually maybe connect that to the SDGs and could help the companies in deciding which of the SDGs that are most material, you could say, even to the company. So those were a few reflections.
Do you want to comment on the SDGs?
No, it's a good question about the SDGs. So let me answer your question and then raise another issue, which is related to something you said. So you said cherry picking. I would say they need to be selective, right? I'm doing a project with a professor at Siena where from another paper, someone has mapped the SASB issues to the SDGs and then broken those down to what the material issues are for the sector and mapped those to each of the SDGs to try and determine which of the issues for that sector touch which SDGs, right? And we're in the very early stages, but what you'll find is that there's big differences in terms of the potential, in terms of number of topics, how industries impact the SDGs. So just as a very simple metric, we've looked at what the top 3 sectors are in terms of the number of SDGs. Healthcare is in the top 3 for, I think, all but 2. So non-renewable resources is high up, healthcare is up. So there are certain sectors that if they get their act together, it's good for the SDGs, broadly speaking. There's other sectors that the SDGs that they're going to impact is, it's much more narrow. Then when you get to what the business indicators are that they're trying to come up with SDGs, you get this tension between materiality and impact, right? So we've talked about this before. SASB's definition of materiality is basically, do investors care about it? The GRI's definition of materiality is quite different. It's basically as a positive or negative externality being created in the world, right? And what they're trying to do with the SDGs, with GRI and the Global Compact and the WBCSD, is not have just kind of the outcomes that come from companies, but what is the impact that it's having in the world. And that's even harder. And one of the best pieces that I've seen on that, there's the Cambridge Institute of Sustainability Leadership, and they've done a paper on how you would measure impact. And when you get to impact, you start to get to requiring data that comes from outside the company. So let me give you a different example. You can say, jobs created would be an outcome from a company in a community. So you can say we created this many jobs. The impact would be because we created this many jobs or because we're paying a living wage, instead of what the minimum wage is. Infant mortality goes down, high school graduation rates go up, healthcare improves, upward mobility improves. And so when you start getting into those areas, it becomes very complicated because you're now starting to try and figure out what those cause and effect relationships are that are coming from the company on the world, and then how you'd get the data to measure that. And I just don't know the answer.
No, and I would add, I have to look that paper up. Thank you. I'm thinking also, not only do you need outside data, but you need longitudinal data.
Yep.
And then there's also the issue, which is a little bit of reflection on also what you were talking about, trade-offs. I'm thinking here. There's a lot of trade-offs that perhaps are not so much discussed here, I think. Do you want to say something? Because we do know, we actually have research at our center that's been looking at modeling trade-offs in the SDGs. For example, if you decrease child mortality, increase education, you're actually going to have a higher CO2 emission. These are interesting trade-offs. How do, not least of all, how do companies deal with that when we're talking about materiality here?
That's a good point. I mean, because you've got the issue of the trade-offs at the sort of system level. People say the SDGs is the closest thing the world has to a strategy, and the elephant in the room is everybody's acting like all 17 can be achieved, or the 16 and the 17 is the public-private partnerships. And you just gave a good example of why not be the case. You know, there's going to be, we might do a pretty good job on this environmental stuff, and some social things will suffer. It's the same thing down at the company level. There's trade-offs, right? And that's why I think, you know, the shared value thing I think is going in the right direction, but it's a little bit light on recognizing that you can't please everybody. And that's why I think you have to be clear about the significant audiences, and why that 2x2 that I showed up there from George's study, that the companies that were doing the best, they were making the trade-offs. Their performance was good on the material issues, and it was actually bad on the immaterial issues. So they were making those trade-offs.
Let me switch gears here a little bit. You said that Sweden is a good place to work on this and to start with the statement and so on. And Lynn, you have been doing some research on Swedish large cap companies specifically. Do you want to sort of give a few thoughts on that, and what is the direction? And are we sort of feel that we're on the front lines in terms of sustainability in the Nordics, not only Sweden but in the Nordic countries? But are we really? And if yes, is it because the companies are so good, or is it because of the regulation and the governments are doing the heavy lifting?
Oh, that was a really complicated question. What Anna's referring to is that we just did a follow-up study called Walking the Talk at MISUM, where we looked at the large cap companies and their sustainability communications. So what we're really looking at is, what is it that they're communicating, and not least of all, what is it that they're communicating that they're actually following up and doing? How can we be able to see that? There's different questions here. I think, one, I think it's really difficult to say whether or not Swedish companies are, the front movers on sustainability per se, because sustainability is so wide. The Swedish companies, I would argue, are pretty good when it comes to the environment and measuring that. You, Telia, yourself, not only did you do very well in the report, congratulations, but you had to go to Denmark, for example, to get the human rights impact work, and worked with the Danish Institute on Business and Human Rights, for example. So I wouldn't say that the Swedish companies necessarily, neither research or the companies have been particularly at the forefront when it comes to the human rights issues. I think other companies have been better at that, but most definitely on the sustainability issues, I do think is better. I do think that there's a reason why Bob keeps coming back to us in Sweden. I think there are interesting things going on in Sweden, and that if you look at all sorts of types of rankings, Sweden does very, very well on fairly progressive things that are valued more than, or not valued more, but interconnected with the economic growth. Such as on the welfare side and human development indexes, etc., innovation. Honestly, I think that Swedish companies are much more progressive than the Swedish government is. I would argue that through the years we've seen most definitely that, yes, 2007, Sweden was very far ahead when it came to being the first country in the world to go out and say that we would report, all state-owned companies would report according to the GRI. But since then, a whole lot hasn't really happened. And some of the forward-thinking, more progressive companies, I would say, are pushing the government to come with more regulations, actually, to level the playing field. So I think there's really good outliers, but then there's also a lot more other companies on
Why
that.
do you think that shift happened from the government?
Well, I think it's the same thing all over the world. If you take the US or you take Brexit or what have you, it's become much more populistic and short term. And I think the companies are seeing maybe going from the risk minimization and cost side of sustainability to the opportunity side and seeing it more as an investment for the future, more so than the politicians almost do.
It's the sharing economy. We're not talking at the same time, so we can use the same mic. I want to go back to you, Bob, still, when we have a few minutes of time. You were talking about the barriers. You were talking about not exactly maybe having the same language, the investors and the companies, and the need to increase that cooperation. What would be the very pragmatic, practical advice you would give to us in this room, both companies and the investor side, that what is the first step we should do to start climbing those barriers?
So good question. I'll repeat some things I said and then I'll add a few other things. So on the company side, have a rigorous materiality determination process for audiences and distinguish between investors and stakeholders, because I think GRI is the gold standard for me for sustainability. Stakeholder reporting, I think SASB's been more designed to be for investors. So come up with a point of view, say these are the material issues, be clear, and then integrate that into your investor presentations. Companies that are really doing quite, impressive things and truly have sustainable strategies, you look at their investor presentations and there's nothing. There's nothing. Maybe they talk about governance a little bit. There's nothing, right? So the company ultimately shapes the conversation. It's their responsibility to put that in investor presentations. It's their responsibility to bring that up in the quarterly calls. We're doing that Action Lab project with her colleague Hannah Sederberg, trying to change how companies, communicate in their quarterly calls. I think getting the board to take a stand through this statement thing, that would be on the company side. I think that the still on the company side, the CFOs need to learn how to talk about this stuff. You need to get the internal control systems to be of the same degree of quality so that they're comfortable with it and reporting on it, and that plumbing needs to get fixed. I think on the other side, the sustainability people need to think more about how they can articulate what these things are doing for financial performance. You've got, on the investor side, a similar thing where you'll tend to have your ESG group, and then you'll have your sector portfolio managers in the different asset classes. And what needs to happen is not just the SRI investors or the ESG people that come and engage with companies. Until you get to the point where the sector portfolio managers really believe that these ESG factors matter and are trying to incorporate these in their models the best they can with limited availability. And when the sector portfolio manager, not the ESG person, when the sector portfolio manager in quarterly calls and investor meetings, one-on-one meetings, AGMs, when they start asking the CFO about it, that is an incredibly powerful signal. So short example, my buddy and my co-author on this integrated reporting book was meeting with a company, which shall go unnamed, an insurance company in the United States. They've been doing sustainability reporting. He gives them the pitch on integrated reporting. Person in charge of sustainability says, well, boy, this is a timely meeting because investors are starting to ask us about this stuff. So when U.S. companies, investors in the insurance industry are starting to ask about ESG factors, you can see that things are changing. And the investors, for what I'm trying to do, this whole thing around quality and standards and all that stuff, the investors are the key to this. Because when investors demonstrate that they know that this matters and they're incorporating this in their models and it's affecting their investment decisions, that's going to both create positive incentives and put pressure on the companies like you to say, okay, you know, we have to start talking about this.
Do you want to add something?
I kind of think about maybe more non-financial sides than you're talking about. I do think it's incredibly important, as you mentioned a little bit, the tone at the top. If the board and the chairman, which I know in this case has been very involved on the sustainability side and very much pushing for this, I do think that you can, given the short-termism that it is in the financial markets, right? You're going to have to play both games, but getting in the long-termism, I think that has to be really driven from the tone at the top of the organization. It has to do with not least of all integrating throughout the organization. We had the talk earlier today on the human rights impact, and it's a fabulous piece of work that's been done here in Telia. Not least of all, it's been a journey, as we all know. But the question then is, you know, does this just stay in the sustainability department, or does it actually get integrated within the organization? I actually don't think that you can take away a head of sustainability or that department, because you need to be working continuously with those who do not know the area as well. And I think that's as important as the financial side. There is the issue that, you know, if you take a little bit more of a systems change perspective and a stakeholder perspective on the role of business in society and what kind of role you have in society, I don't see the company as a goal in itself. If we make, you know, take a bigger picture of what society is, it's a part of society. It's a part that is very important. It's the way that we've organized our modern societies. But I think it has. And I'm not sure if this is maybe reflecting also a very U.S. Perspective versus a much more of a stakeholder perspective that we have in continental Europe. In our laws, we have much more of a stakeholder perspective than a shareholder perspective. So I think it comes naturally to us in a different way. I don't know if I answered. I went off on a philosophical tangent here.
Let me just put in a plug for it. So there's a colleague of mine named Colin Mayer who wrote a book called Firm Commitment. Fabulous book. So get that book. And he's got a new book called Prosperity. And he directly gets at this issue of the role of the corporation in society. So it's not published yet, but basically the storyline is that this phenomenon of a corporation existing just to make profits is a relatively new construction, right? I mean, that's not what corporations have been through most of the time. So not for this Christmas, but for next Christmas, put on your list for a stocking stuffer, Colin's book called Prosperity.
Thank you.
And I'm not his agent. I don't have any economic interest
I'm sure.
in this. I have no economic interest. Nope.
He has other great books that he does have.
Yeah, buy those.
Buy those.
If they're still in print.
He's marketing so many books, so we thought it might be.
Go buy that book on transfer pricing. If you can find it.
Thank you very much, Bob. Thank you, Lynn. Very, very interesting. Some very concrete advice for us as well going forward. Definitely a lot of inspiration. Thank you very much. And as said, you will get the slides. And if you have any further questions and so on, we're going to be here for a little while. So feel free to come and have a chat. Thank you, everyone.
That was fun.